Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of March 16th, 2025. And in this week's episode, I'm joined by fellow Blockhead Trader Viper XL 007, and we are going to take a look at what the option. Lately, Viper's been dabbling a little bit on option buying, and so we're going to take one of his most recent trades on the TLT ticker. We're going to take a look at what option trade he took, and then kind of look at what he might consider moving forward from the perspective of utilizing options as synthetic shares. That's not normally the topic I cover with options, but it is one of the main features of options where you can, for a small amount of money, control a large amount of shares, which gives you the synthetically long or short, whatever way you want to trade it. So we'll take a look at that in this week's episode as well. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. And now there is also /Viper XL 007, as he has been dabbling in the option trading and posting some of his trades. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's episode. So Viper, you have been trading options a little bit, just a little bit. And I know we've had a couple of conversations out of band from the show, and I thought we can maybe take this episode a little bit and take a look at just one of your recent trades. I think you had selected TLT as the ticker to look at. And we'll talk through kind of your example first, but what I'd like to then focus on is just different aspects of the option for people to consider and how they can basically use options to gain extra leverage and trade them as synthetic shares. They're not really shares, but they can sure trade a whole lot like them. And we'll talk on that after maybe you give us a little bit of intro on what is this TLT trade and what led you into it, and is it still going on, and what's your exit plan?
Yeah, indeed. Like you said, I am now 9 trades deep into the land of options. And it's going, it's going well from the experience and interesting perspective, and kind of like we talked about before with finding something interesting, finding a strategy and whatnot. All things considered, profitable, as you mentioned. People can follow at thetagang.com/Viper XL 007. But reality is setting in, and by that I mean the very first trade I took out of the gate was an absolute banger. Just exceeded all expectations, which obviously I knew would not be the norm. So more trades are coming in. Losses are there as well, and I am currently batting 44% win percentage. 4 wins, 3 losses on long puts. We'll kind of get into that in just a second. And batting 0-2 on long calls, ironically, for later in the show. But the first trade that, not the first trade I took, but the one that I want to talk about here is, like you mentioned, the TLT ticker, which is the 20-year Treasury bond ETF. This was, so the screener that I'm using, mentioned it before. It's an AI-powered screener, and so it is calling out, it's scanning the options chain. It is calling out potential opportunities based on all sorts of various options data. So it's basing it on charting. It's basing it on chart analysis with MACD and other indicators, but it's also basing it on the options chain itself, the Greeks and premiums and things like that. So that's long and the short of it is how it came across my desk, if you will. Was it called it out. And the first thing I look at, we don't need to get into the screener, but the first thing I look at when the screener shows a trade that it thinks it has an opportunity, I look at how old the suggestion is because it, is periodically grabbing things. I look at the price of the option because if I'm buying options, I want that premium to be low. So typically I'm looking for buying things that are less than 50 cents, less than 40 cents is great. 25 to 20 cents is fantastic. Because I'm buying it. And when you buy it, as we've talked about before, that is 100% right off the gate. That is a cost. It is the maximum loss scenario. Whatever you pay to buy the option, that is your maximum loss. You will never exceed whatever you paid to buy it. So that's one thing that I like about buying options. In addition to the syntheticness that we'll get into in a minute. But one thing that I like is it's a defined risk immediately up front. There is no surprise like, oh no, this thing just completely reversed on me and now it's just blowing up in my face. There's none of that. And it could be dangerous. So like we talked about last time, if you show up and you're like, I'm going to put $10,000 into this, that could get extremely dangerous, extremely reckless. So I'm using that risk mitigation and defined risk right out of the gate. And so I'm like, whatever my position, whatever my acceptable loss for any particular trade is, that's the money I put in up front. So now from there on out, my max loss is understood. I could bail out if I wanted to, but I let the trade goes forth from there. So that's one of the things that I really like about it is getting that defined risk up front, with potentially very large upside should things pan out in my favor per the leverage nature and whatnot. So we can get into that specifics in just a minute, but let's take a look at this TLT because like I said, this popped up and one thing that I want to specifically call out here, as anybody should do, I mean, especially in this age of AI tools and things like that, the worst thing you could do is read the suggestion from an AI tool to do this thing and then just immediately go do this thing. And I say that because you should understand things like charts, understand the underlying, understand what you're doing, all the stuff that you hear us talk about all the time here, and we will continue to talk about. So this screener said, hey, opportunity on TLT. So it met my criteria as far as price of the options. Initially, they were 40 cents. So I went over to the chart and I said, well, let's see what's going on. And the screener suggested taking a long put, which is buying the put side, which is synthetically going short the stock. This is also another benefit to me because I primarily for this account use Robinhood, and you don't have the ability to go short on anything in Robinhood. So buying options, buying long puts gives you that ability to go synthetically short. So I opened up the chart and just did what I normally do to chart it. Going to skip a lot of the details, but this is the weekly chart showing TLT from the very beginning. This is an ETF, 2002. It came on the scene. You can see that we're up. Then we had this very large down crash, and it's kind of just been ranging down here for the better part since 2022, fall of 2022. So as I was doing my chart, as I always do, I spotted this key critical weekly level here, this range here. And then more specifically, approaching the price when I first found this price was approaching the bottom of this range. So I was I like that as far as opportunities to capture. You want it to be doing something near a critical range. This was approaching the bottom side of this key range here after failing to hold the range. It gained the range, dropped below. So failing to hold the range and now approaching from the bottom side, that to me and how I'm reading this chart is a great opportunity to go short. So I basically DCA'd twice into this position. So initially the first buy-in I did is this circle right here. It was coming up here, and we're kind of in the middle of this range between the weekly level and this daily level. So I didn't want it because there was still the potential to test the bottom of this weekly level. So I didn't want to whole hog the position in the middle here but I wanted to get in. I wanted to, experiment with this strategy and whatnot. And the price was decent here. Like I said, I think it was 40 cents for the options here. So I decided to split the position. I said, I'll buy half of it now. If it never gets to the bottom of this, great. I'm in the position if it comes down. But if it does get up here, even better. Then I'll DCA the rest of the position. That is exactly what happened, as somewhere up near this top here is where I bought the rest of the puts. And I bought those puts for an $89 strike, which is all the way down here. It is below this range, but that was where the pricing was favorable. All in total, because the options got a lot cheaper on this second circle here. So all in total, I think my cost basis was somewhere around $30, 30 cents, 28 to 30 cents, something like that. And then, the chart kind of gives away the end of the story here. It just immediately had this move all the way down here, which is fantastic. The position was well in profit, but saving it for another episode. Profits were not taken just yet. And then it bounced off of here, is failing here. And you can see that we are currently in another retrace here. So long story short, the expiration is in a week. These expire on March 21st, which is a week and a half from this recording. So with this, with the position is back in profit. It went negative on this upswing here. It's back in profit, and I'm looking to probably close this thing out by the end of this week, especially if we get just 1 or 2 more days of downward pressure here, or an opening significant move down. Again, that volatility expansion. If we get any volatility expansion, that's a capture moment. But one reason that I'm looking to get out of this trade is on this hourly, we can see that we're in a reversal uptrend here. There is, on a very high level, the daily, the weekly view, there is still sort of this downtrend happening here. But this key range here that we're playing around in, we very much could accumulate here and then give another push up to this weekly range here. And I don't really want to mess around with that sideways action for my strategy. Sideways action is very bad, because that's going to bleed off the premium. It's not in my strike. I'm not in the money. So anything sideways means volatility drops. Anything sideways means premium drops, which means I can't get money back out of this. I need that volatility expansion and all that good stuff. So I'm potentially looking to close this thing out from those fundamentals of the options, but also because this is a key range here where it could accumulate and it could continue to push up and open up a potentially long scenario.
Yeah, so a couple of points here that I want to call out. Your circles of your buy. Your first buy, you said you paid around 40 cents, I think you said. And then that second circle, you go, oh man, it was a lot cheaper. I think you said 28 or 30 cents, something like that. And what I want to call out there is the reason that got so much cheaper is because you kept the same strike of $89, and you don't have that much time to go to expiration. And so options premium will drop off very quickly the further away from the money you get. So that basically means the further away you are from your strike, the faster that premium is going to drop off. So when you made that move higher, you got farther away from that 89 strike, and you only probably had about a week and a half or 2 weeks to go. And so you don't have a lot of time left on that option. So it's going to drop off really quickly. The other thing I wanted to comment on, you said, hey, when you go sideways, you're going to lose volatility. That is true. However, in this particular time frame, your extrinsic value, right? That is the value that is outside of the option, is going to be primarily theta and volatility. But when you're this close to expiration, it's going to be a whole lot more theta than it is volatility. And theta is time. It's the Greek theta t, and so your theta is actually going to burn pretty quickly. Yes, your volatility will also go down, so it's kind of a double whammy. Your volatility is going to decline, and your time is going to decline.
So in this particular case, then, sideways is still bad, but like you were just saying, sideways is bad because sideways is just closing the gap to the blue line here. It's literally the time sideways versus this was a much further dated option 6 months out from now. Sideways is now going to have that volatility impact rather than the time impact.
Yeah, it'll have both, but both will be somewhat muted the further out in time you go. And that's one of the reasons that we're going to talk here a little bit about synthetic shares and why you might want to consider a much, much, much longer dated option for these type of swing trades. Yeah, so let's take a look here. What I want to call out is I want to take a look at the option. This is a view here of premium. So this is a view that I can show you in Thinkorswim, and what we have here is TLT, and we have out of the money extrinsic value. And what you see is it looks like a bunch of mountains. And where you see the peak of the mountain, that's basically where the TLT is currently trading, about $90. But what I want to call out here before we go mock up some of these trades that we might put on is I want to call out, notice how the mountain is like skinnier and skinnier and shorter and shorter. And what that is these are basically every different option expiration strike, time-wise, not strike. Well, I guess it also is the strike prices too, but it's all the strikes and all the times. So some of these colors are closer, and then as they get taller and taller, these are farther and farther out. And this goes to show you when your option got really cheap is because you were close to close to expiration. So think of it as one of these smaller mountains. But look how quickly that mountain hits zero from an extrinsic value standpoint. It's not that far from the money, which is why the value falls off so much. If you look at these taller mountains are much, much further out in time of expiration. So there's 31 series here. We'll just take them all out. I'll put the two extremes. So here's a series that expires this Friday, or the most recent one. And then here's one that expires in 2027. Well, that might be a little bit of a difference or extreme. Let's just pick something that's the end of March right now, and then the end of 2027. So look at the difference of these mountains. The blue one is the one that expires at the end of 2027, and this is the premium in it. And look how far away from the money this premium resides. Whereas this smaller red one is the one that expires at the end of the current month. But look, this premium goes to almost zero, within $5 of at the money. And so that's what I'm talking about. The further out in time you go, the more premium there is. Well, the nice thing is this premium is going to decay a lot slower farther out. So what I'm going to switch over to now is the option chain. And this is where I'm going to show you where you might want to consider different ways to trade this. So what we're going to do here is we're going to take a look at the simulated trades. And we're just going to go ahead and buy an option at the current strike. But we're going to go out and we're going to take a look, and we're going to go all the way out to November 21st of 2025. So this is 254 days to expiration. And we want to be long, so we want to buy a call. So let's buy a call at $90. Okay? And this is what I want to show you. You might think this doesn't mean that you need to hold this thing till November of 2025. It just means we're going to buy it with a lot of premium in it. So we're going to pay more for it. But the reason we're going to do that is because your trade thesis is you're going to get the move that you want sooner. And then you can go ahead and unload the option. And I'm going to show you this in the P&L. So if I do a little bit of shrinking here so you can see. So this is going to cost $4.90 or $490. Now, this is what I'm talking about synthetic. So this is synthetically long 100 shares because this is one contract. If you wanted to buy 100 shares of TLT, you're going to pay $90 a share at its current price times 100. So that's $9,000. So in order to reap the return on 100 shares of TLT, you're going to spend $9,000 if you bought the shares. Whereas if you buy the call, you're going to spend $490 to control the same notional value. So now I want to show you what I mean by your time premium is not going to decay that fast. So this is the P&L chart. And if our target is $96, what we're going to pay attention to is the difference here in blue and purple. Okay. So at $96, pay attention to the blue and purple lines. That is the value, estimated value of that strike when the underlying is at that price. Okay. So on March 13th, if we hit $96, that option would have a value or a profit, not a value, a profit of $370. Now that is taking into account already the $490 that you are paying. So it's effectively, $700, $800 total value. But what I want to call out, I'm going to do this two ways. What I'm going to do is I'm going to advance the time clock day by day, and I want you to pay attention to that purple line and watch how much it moves. I'm going to go from current time here of March 13th, and I'm going to take that all the way to March 30th, and I want you to see how much that purple line moves. Okay, so this is 1 day, 2 day, 3 day, 4 day, 5 day, 6 day, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18. Okay, 18 days. Did you notice it move? Probably not very much. So let's go back to that 96, $355 still profit there. And that's because we are so far out in time that there's going to be almost no decay on that premium. So yes, you are paying more premium up front, but if your play is going to be short, you're going to get that premium right back when you sell the option to exit the position. So its impact on your overall trade is going to be much more negligible if you stretch out in time, because you're not going to get as much decay over shorter time now compared to the grand scheme of what's there. So let's flip this thing and let's say, you know what? Let's pick the same thing, but let's not go so far out in time. So we're going to go back to the option chain and let's say, you know what? Let's just take an option that expires at the end of the month. So that's in 19 days. Let's go ahead and buy that $90 call, same strike. Now it's a lot cheaper. It's only $1.17. So you're going to spend $117 to control the same notional value that would cost you $9,000. Sounds like a great deal, right? Well, let's take a look at that P&L chart. Uh-oh, where the heck is that purple line? Let's come back to where we started. It's not very far off from that blue line. So what do you get at $96? Well, you get, 488, but you're not getting any of this purple. Like your purple is not, you're not spacing it out at all. And that's what I kind of want to show you here is that when you go really short, it's fine, but you're really not, this premium is going to completely decay away. And yeah, you're not paying it very much up front. But you also, if you get a big move, you have less of a chance to get this move is, I guess, what I'm trying to say here. So, Viper, how does that strike you? I think it really depends on your time horizon. And yes, kind of going way out in time is more expensive. But it might give you a little bit more cushion. And because you're not going to lose as much of that value, maybe it doesn't impact your overall trade that much. Versus, maybe in this case, it's a better risk reward ratio for you. It really is up to personal preference because you're going to spend a lot more for that, $9,000 of notional value. And if you do hit your 96, your profit here would be, $468. 468, 464, somewhere in there, which is more than that 355 on the other route. But if you don't quite get it right, you're going to get quite a difference, and your option might expire to no value.
So many thoughts. I'm just gonna think out loud, and I think more than anything, certainly correct anything that's wrong. But I think, and really, I mean, I'll spoil the ending, I guess, by echoing what you said just a little bit ago there, as far as risk tolerance, risk to reward ratio, personal preference, all of that stuff. Because and some of this I think needs to play out in what is your exact strategy and purpose on this play. But let's just keep using the numbers that we just saw, because we just saw them. And that is, on one hand, so that we're going to say that it's going to take 18 days. And in 18 days, we hit $96. It was roughly, I think that was what you did. And we saw $355 profit on the 2027 target option, and $490 profit on the very short end of the month option. However, the long one that got the 355 cost $490 up front. Short one cost $115 up front. So apples to apples, risk to risk. And I mean, and this is I'll plow through. So to apples, then it would almost be, in my mind, that you would have to invest that $490 that you would have done for the long one on the short ones as well, which means now you're buying four contracts instead of the one long contract. And in theory, that's the same risk to the confines of the play that we laid out there, which has a much larger profit disparity. So I guess before I let you react to that thought, I'll say I'm not arguing for or against either one, but that has the much higher profit potential on the short dated one, because, like I said, to spend $490, if I showed up at the table and said I have $490 to put into this, I can put it into one contract or four contracts. However, going back to that risk to reward ratio and all that sort of stuff, those four are about to be dead a lot sooner than that one is. But that's kind of a lot of I guess, without getting too much deeper into the weeds, that's kind of what's on my mind when I see that. Is, yes, the very long dated one has the much more premium built into it, much slower decay of that premium, but it also has the what you're paying for in that scenario is that more conservative, slower reward on it, which I mean, it's still a 70% profit. So I don't want to say too slow. But it's just playing through that in my head, as far as, and that kind of goes back to what I said of what is your specific target and goal with this trade. Because I feel like that also plays into which one is the better option for anybody.
Yeah, and that's actually an excellent call out, Viper, because I think you're really kind of underscoring the point that I think I'm trying to make here, and that is understand what this is made up of to see how applicable it is to your strategy. So I put this back up here, and I made some adjustments, and I said, you're right. If you're ready to risk, $490, then you should quadruple that trade at 117. And if I look at just that quadruple trade, if you were to hit that value of, $96 by the time before expiration, yeah, your profit is going to be $2,000. So you're 100% right there that your risk to reward is much, much better in that first option trade. or sorry, the option trade that's shorter dated. Because also you're not really controlling $9,000 of notional value if you quadruple it. You're controlling $36,000 of notional value because you're basically picking them up for a quarter of the price. And I guess the other aspect that I want people to be cognizant of is I'm going to flip it now to the longer dated trade. But what I want to show you is if you were to exit more quickly, you can still get a profit. Like you still get a large chunk of your initial 490 back. So that's this purple line is basically the value now versus the value at expiration is the blue line. So you can see if you took that long dated option and rode it almost to expiration, you would have to seriously be right on your price move a whole lot, because at 96, right, the blue line is only $100 profit versus the purple line now would be 361 profit. So you're right. Like, it is a more conservative way that your theta is not going to go to zero, and that's why a lot of people go these short dated calls or these calls that are pennies. And so when they target, they're not actually targeting strikes for what calls they buy. They're just saying, okay, what call is 5 cents? I'll buy whatever call is 5 cents. Because you can get a lot of price movement on a short dated option. So I switch back to the shorter dated one. You'll see a lot of your price movement will happen along the blue line faster. The shorter dated the option is.
So one other thought then to maybe try to help, because I mean, I definitely have a much better understanding of this now, but I do know for a fact, because it was me, that in the early days, a lot of this takes a while to get your head and wrap around all the nuances to this. So another potential thing that I'm thinking of is, because we're talking about being synthetically long X number of shares. So would you say it's fair to say one idea, and this is certainly not to be a rule of thumb of like, if this, then always do this, but if the play is to capture a potential move, and let's just say it's a short move, like, so again, we just called out $90 to $96. So that's a swing. That's not like some long-term target. That's just a swing move, bink to bink. So if the play is to capture a swing, to me, and then we'll see if you agree or, whatever. To me, to capture one swing, simple move, it makes more sense to be on the short dated, factoring on all the risks and factoring in all the stuff that you need to factor into, because of that, everything we just talked about. But to get to the point of synthetically long, it does make a lot more sense to go the long dated one, but maybe when you're trying to capture a much larger move. And so to bring the point, I would say, instead of doing this 90 to 96, let's say, because we're talking about a very long dated option here, that I'm like, no, this chart on a long time, on a year plus time frame, I'm thinking we could see $110 on this thing. So I still look at the $96 strike because I want to be synthetically long 96 to 110. And so I buy that 96. So once we get in the money, cross that 96, now I have that synthetic long. I have that control of that $9,000 worth of shares. And now it's just intrinsic value of the move from 96 to 110. And so in that scenario, I don't know, maybe because it's I don't know, maybe it's not as this or that, but that was just one thing that came to mind as far as putting your strike relative to your target.
No, you're right. You're right. And actually, so let me, I threw another one out here because, hey, why not? When you go with a synthetic long, one of the things that people will do is they will buy a deep in the money call. And so the goal there, right, is to get that almost 1-for-1 price movement, but you don't want to pay that premium, but you want to have it for a long time. So if you buy something deep, deep in the money, you're basically buying that intrinsic value. So what I put here was buying a $60 call. So you're basically going to pay that $30 that you're in the money because it's trading at 90. You're buying a call at 60, so you're right now in the money, and that's going to cost you about $30. But look at this P&L chart. It looks almost like shares. So if I was to add 100 shares on the same thing of ETF, and we wanted to look at the P&L chart of straight shares, it's a diagonal line, right? Well, right here is buying a deep in the money call. So it's more expensive, costs $3,000, but you're paying $3,000 to control $9,000 notional. And so I think if you wanted that longer term trade to really be synthetically long shares, the better move would be to still keep your extrinsic value very, very low. And the way that you do that is you have to go very far out of the money, but you're going into the money to get far away from the strike. And I think that might be a better way to be very synthetically long shares because you're not going to be impacted by theta decay because what you paid for, there was almost no theta whatsoever that far deep in the money.
Yeah. Yeah. And actually that makes even more sense. And answers a question that I've had as long as I've messed around with options, because the perspective I've had with options has always been this, the decay and the time to expiration and all this kind of stuff. And it's always crossed my mind of like, why the heck would anybody buy something in the money? And because my perspective was the move already happened. It's done. We're in the money. Why would you buy $60 when we're at $90 and you do, but this is exactly why, because like you just said, you go in, you buy the 60 for $3,000. So you essentially have a 3 times leveraged long on the position, and until it hits $60, so you're terribly wrong. Price starts dropping. You're losing money off that 3,000, but you're losing it relative to the price of the shares that you're synthetically controlling. So yeah, that's a good point. That's even better way to truly be synthetically long is go deep in the money and literally just pay for the move that you missed, and then you have that leveraged exposure towards the future.
Yeah. So on this example of going deep in the money, right? You hit that 96. Look what we get there. If you hit your 96, doesn't really matter, today or tomorrow or what have you, but you're going to pull in that $600 of profit. And one thing to just keep in mind, I'll throw this out here, right? The deltas. So here you can see the deltas of them. And one of the ways that you can view a delta, one is the probability of being in the money. But the other way to look at it is how much does your price movement trade with the stock? So at a 97 delta, that basically means a $1 move in the stock will move your option price by $97. So that means it's almost, it's 97% correlated to the price movement of the stock. Whereas if you're actually buying, at the money, it's going to be very close to a 50 delta, which means a $1 move in the underlying is only going to move your option price by 50 cents. And so that's the other thing that's happening there. When you go so deep in the money, you're buying such a high delta, you're effectively buying a 1-for-1 tracking device on the underlying for a fraction of the cost. And that's that leverage, that 3x leverage. So Viper, that's a little bit about some of the mechanics. I know we don't want to bore everybody too much, but hopefully there's a couple of nuggets in there. I don't know if there's any last minute things that you jump out to you, but I think it hopefully opens your eyes up a little bit to some of the things that make up an option and why I think they are one of the most flexible trading vehicles out there.
Yeah, I would say the one thing that I want to call out and make sure we highlight and I think we did a pretty good job highlighting it. If you didn't catch it, go back and watch again after I say this. But I think we captured pretty well that the most important thing when messing around with options is understand how fast can the money evaporate. In very, very layman's terms, I think that's what a lot of options plays come down to. There's obviously so much more to it, but I think it starts with that question of, I'm about to buy this or I'm about to sell this or whatever. How fast? Well, we'll just stick to buying because that's the synthetic part. How fast does my investment into this, how fast can it evaporate? And I think that's kind of what we highlighted with the short, with the long dated, and then even with the deep in the money. And I think that's the one thing I really hope comes through, because that's where the risk is. That's where people get into trouble, is they don't understand how fast the money can evaporate. They go into that short dated option seeing that quadruple, and they're like, I got 10 grand that I just got from XYZ, and I'm just going to go throw it into this, and it's going to quadruple. But it's also potentially going to evaporate in 3 weeks. So I think that's the takeaway for me.
Yep, definitely agree on that, Viper. And that will bring us right to the end of this week's episode. Like I said, it's out there. Really understand what the option is doing, what it's representing. And spoiler alert, I know a great place you can go to ask questions. Link in the description below. Hop in our Discord. We love to entertain and talk about different people's perspectives and trades on options, or, hey, I'm considering this. Hey, I'm considering this. What's the benefit of this? You don't even have to be actually taking the trade. Just hop in there and talk to us. And there's a couple of us in there that are very well versed in the premium selling. There are others that are very well versed in the option buying. It's a nice array, and it's just a way to get another data point, because you have to go way back in our catalog to find it. But I know that one of the things that Viper and I have both kind of stressed as to kind of forging your way into this field is it's really helpful to have a phone a friend. And so I guess this conclusion is turning into a giant plug for our Discord. But that's really where I think learning happens. You just find someone else who shares a similar interest. You bang a couple of questions against them, see what sticks. Maybe that's not a data point you want to take, and you look somewhere else. But it really, really, really comes down to understanding the mechanics of what you're trading. What is it representing? What is it doing? Because when you really understand all of the inputs, the outputs, the ups, the downs, the lefts, the rights, all the different mechanics of it, you really, really do get a much more comprehensive knowledge on what it is you're trading, and it will lead you to better decisions. It will lead you to more profitability. And of course, all of those things are very important for that foundational of wealth building. So all that said, I hope you are finding trades that you like to take out there in the market. And there's definitely not a shortage of volatility trades these days. So good luck out there. Have fun. And remember, think outside the block.